year after year. This business owner was overpaying about $52,000 in taxes. Not once, not a bad year, every single year. That's over $260,000 in 5 years, more than $500,000 in 10. And nothing looked wrong on the return. Income was reported, taxes were calculated, everything filed correctly.
So no mistakes?
No clear errors on the surface, which is exactly why it kept happening, because nothing triggered a correction.
So it just continues?
Exactly. Not an obvious error, but an ongoing inefficiency. Welcome to Ivy Smart Tax. This is a tax leak case. Single parent, one dependent. Total income about $1.18 million. Split between W-2 executive income, S-Corp consulting firm, $780K profit, minor investments.
So they're already structured?
Yes, they have an entity. They have multiple income streams. They have a functioning business, which is why this case matters.
Because it's not beginner level.
Exactly. This isn't about setting things up. It's about how those pieces are working together.
So the structure exists, but it's not doing enough?
Exactly. Structure existed, but it wasn't optimized. The issue here wasn't income. It was misalignment. Compensation was off. Deductions were there, but not coordinated. And the timing of income recognition wasn't working in their favor.
So everything technically worked, just not together?
Exactly. If you looked at each piece individually, nothing appeared incorrect. The salary was there, the deductions were there, the structure was in place. But they weren't aligned in a way that actually supported each other.
So the issue isn't missing pieces, it's how they connect?
Exactly. Because tax outcomes don't come from isolated decisions. They come from how those decisions interact within the structure. And when that coordination is off, you don't see one obvious mistake. You get small inefficiencies that repeat every single year. That's where tax leaks live. So, instead of chasing one big trick, we focused on stacking strategies. Not one aggressive move, not one risky decision, but multiple adjustments that each improve a different part of the structure.
So this isn't about finding one perfect strategy?
Exactly. Because in real tax planning, the biggest results rarely come from one move. They come from layering smaller decisions that work together. Each one on its own may not look significant, but when aligned properly, they compound.
So this is not one move.
No, this is a system. First, S-Corp salary calibration. Their salary was set at $65,000, while the business generated about $780,000 in profit. That imbalance may create audit risk and inefficient tax positioning depending on the facts, because the compensation doesn't reflect the economic reality of the work being performed.
So the salary is too low for what they're actually doing?
Exactly. From the IRS perspective, that gap raises questions. And from a tax perspective, it means the structure isn't properly balanced. So we adjusted the salary to about $185,000, a level intended to better align.
Wait, raising salary saves tax?
Not directly. It creates the correct allocation between wage income and distributions. And once that balance is correct, the overall structure starts working more efficiently. After the adjustment, the income didn't change, but how it was exposed to payroll tax did. Less income was being exposed to inefficient payroll tax treatment, and more of it was properly allocated.
So the business didn't make more, it just kept more?
Exactly. Same total income, same operations, but a different structure changed how that income was taxed. Result, approximately $25,000 estimated annual tax savings.
Same income, different tax?
Exactly. Next, accounting method mismatch. They were using accrual accounting, with about $210,000 in receivables, which means that income was recognized for tax purposes when earned, even if cash had not yet been received.
So they paid tax on money they didn't have yet?
Exactly. From the IRS perspective, the income already exists. But from a cash perspective, it hasn't arrived. That creates a gap. Tax is due now, cash comes later.
That sounds painful.
It is, because at higher income levels, that timing mismatch can create real pressure on cash flow. We switch them to the cash method with a Section 481A adjustment. That change realigns when income is recognized, from when it's earned to when it's actually received.
So now tax follows the cash flow?
Exactly. And that transition adjusts timing differences in income recognition under Section 481A. Result, approximately $48,000 timing-related tax benefit, one-time impact.
That's huge.
It is, because timing strategies don't change the business. They change when tax applies, and that shift alone can create immediate impact. Next, retirement structuring. They were contributing, but not strategically. The contributions existed, but they weren't coordinated to maximize the outcome. So we layered salary deferral, employer contribution.
So it's not just about putting money in, it's how it's structured?
Exactly, because different contribution types are treated differently from a tax perspective. And when you layer them properly, they may work together more efficiently, depending on structure and limits. Result: approximately $9,000 estimated annual tax savings, plus better long-term positioning.
So tax savings and future planning?
Exactly, because this isn't just about reducing tax today, it's about where that money goes next and how it grows over time.
So the benefit doesn't stop this year?
Exactly. It continues, because the structure supports both immediate savings and long-term accumulation. Now, QBI. Because of their income level, they were partially phased out, which means the deduction was technically there, but not fully accessible. So we adjusted taxable income, compensation, deferral timing.
So you're not changing the rule, you're changing how they fit into it?
Exactly. Because QBI isn't automatic. It depends on thresholds, structure, and how income is positioned. And once those elements are aligned properly, the deduction may become more available depending on thresholds and limitations. Result: approximately $11,000 estimated additional tax savings.
So QBI isn't automatic?
Not at high income, because once income crosses certain thresholds, the rules tighten, limitations apply, and access becomes conditional.
So even if the business qualifies, you might not actually get it?
Exactly. At that level, you don't just claim QBI, you have to plan for it. And without that planning, the deduction stays out of reach. Next, accountable plan. There was no reimbursement system in place, which means certain expenses were being paid personally, but never captured at the business level.
So they had the expenses but no deduction?
Exactly. In an S-Corp structure, those costs don't automatically flow through. They have to be reimbursed through a formal plan. So we introduced home office utilities allocation.
So now the business reimburses those costs?
Exactly. And once reimbursed properly, they become business deductions. Result: about $2,500 annual savings. Not from adding new expenses, but from properly capturing what already existed.
So the money was already being spent, it just wasn't structured?
Exactly. The cost was there, but the deduction wasn't. And once the structure was put in place, that value became usable. Charitable giving was already there, but it wasn't efficient. The spending existed, but the tax benefit was limited, because under their current setup, those contributions weren't fully impacting the return.
So they were giving but not really getting the tax value?
Exactly. So we evaluated whether any portion qualified as legitimate business expenses under IRS rules.
So same dollars, different treatment?
Exactly. And once the classification changes, the tax outcome changes with it. Result: approximately $2,000 estimated annual tax savings. Not from increasing spending, but from improving how that spending is treated.
So they were giving but not really getting the tax value?
Exactly. Same expense, same behavior. But once the structure changes, the tax result changes with it. And that's where the value comes from. Now stack everything. $25K structure, $9K retirement, $11K QBI, $2.5K accountable plan, $2K charity, approximately $50,000 plus estimated annual tax savings, plus $48,000 one time.
So this wasn't one fix?
No, each adjustment is relatively small on its own, but when they're combined, they compound.
So the real impact comes from how they work together?
Exactly, because none of these change the business. They change how the income moves through the system. And once that flow is structured correctly, the outcome follows. Now the real question: how many years has this been happening?
Yeah, that adds up fast.
Exactly. Because this isn't a one-time issue. It repeats year after year. And over time, that number gets bigger.
So the real cost isn't just the amount, it's how long it's been happening?
Exactly. The longer it goes unnoticed, the more expensive it becomes. But the good news? Once you see it, you can fix it. Follow Ivy Smart Tax. I'll show you where your money is leaking.